Thank you for the re-invitation. I must have done something right last time. And this time I thought I'll start off with the bigger picture of markets, which I at times have labeled the whiplash markets. I'm sure if some of you are paying attention to your portfolios on a regular basis, you know exactly what I'm talking about. It's up one day and down the next, and over a week sometimes it cannot have moved an inch, but on a daily basis it definitely does. Before we go to the nitty-gritty, you know I don't give financial advice. I couldn't possibly do that. I don't know you, you don't know me. So nothing I can say today can be possibly construed as financial advice, but I'm willing and more than happy to share my insights and my views on the way I see the financial markets. And when we talk about financial markets, I thought let's start off with the big elephant in the room. Financial markets, equity markets, are they overvalued or in a bubble or not? And I thought let's just go straight to the core. We've all seen what happened over the past 12 months. Financial markets have had a tremendous year, in particular equity markets. Fund managers are up to 80% sometimes reporting returns. We've had in Australia something that we hadn't seen for a very long time. Consistent all-time highs for indices here. And of course, that constantly raises the question from like, what is happening here? Why is the share market this high? Internationally, economies are hardly coming out of the quagmire from last year, and does it all make sense? The answer to all those questions is yes, it does make sense, and it actually does make a lot of sense. I think I've seen a lot of criticism and a lot of people being very skeptical about what happens in the share market, and that is both from retail investors as well as from professional investors. But I think what most people are missing is that share markets are forward-looking and they are very much guided by corporate profits. And what has happened over 2020 and 2021 is that first we had this fall off the cliff experience, because as economies had to close down and borders had to close down, many companies basically needed help, otherwise they couldn't survive. And that obviously was very quickly priced in share prices. But then it dawned upon the world that things were not as bad, and that's why we have seen a very strong recovery in share prices, which has been mimicked by a very strong recovery that we are experiencing right now in corporate profits and in corporate dividends. So the irony about the share market is that while the average price earnings ratio as calculated on the ASX 200, that it rose very quickly to above 20, as you can see on this price chart here, and that immediately gave way to criticism of we're in a bubble, investors don't know what they're doing, there's too much exuberance out there. But see what happened next, and what happened next is that average PE ratio has actually come down from 22 to about 17 today. And that may seem strange because the share market has actually gone up over that time, and quite strongly so. So what we've seen over the past 6 months, that a rising share market has actually become cheaper. And that is very contradictory at face value, but actually isn't if you realize that below the surface, the increases in forecasts for dividends, for profits, for capital management has basically been stunningly good. It's been so good that few people had expected to be this strong. And so we've had this very awkward situation that what seemed to be in a bubble at face value underneath actually wasn't, and because share markets became cheaper, they could continue to rise until this month, and they're basically still rising. This of course gives us the big dilemma. I mean, how long can this last? Well, at the moment we are seeing 10 very strong consecutive months of very strong increases to forecasts, and that's happening both in Australia as well as in the US, and predominantly in the US and Australia. less so in Europe and in emerging markets. And that momentum, of course, I've written recently that if investors should draw one conclusion from the past year, that is, you don't bet against a share market that is being supported by very strong increases to profit forecasts and to dividends. And historically, when dividends and profit forecasts rise, this usually supports share market. And some people really need to use the mute button. Quickly addressing some of the scary charts out there that obviously have put a lot of people off and maybe kept too much money on the sidelines. This is the typical price chart that has been going around over the past 6, 7, 8, 9 months. It's a backward-looking price-earnings ratio, and you can tell this one goes back to the 1980s. And if you look at that, then the price-earnings ratio of the Australian share market, and you can do the same thing for the US, it has never been this high in modern history. Of course, what this means is that you should sell the share market, of course, and then it goes up and keeps on going up. And you have people like me telling you that you shouldn't be selling at all. Because what this chart misses is two crucial things. You're not looking forward, plus you are missing the context as to why that price-earnings ratio actually shoots up that high. It's no secret. Earnings forecasts last year fell off a cliff. And there was all the reason why that would happen. There was no secret. And one of the lessons, of course, that don't just rely on face value indicators that, and without context and things like this, definitely need a context. Now, it's not just profit forecasts, of course, and actual profits from corporates that move the share market. There's always that looking forward element in share markets. And in this case, as we move past the mid-year in 2021, there are rising question marks about, are those profits, are they sustainable? Can we have, after 10 strong months of corporate profits, can we have 11? Can we have 12 months? Can we have maybe 13 months? And at some point, the increase in forecasts, surely that has to stop. And I think, that probably is the case, but it doesn't mean it has to stop right now, right here. I think the two major question marks that are forming on the horizon here is on the left-hand side. We have, of course, the pandemic where the share market has consistently taken a very optimistic view that we are going to deal with this, and we are, as a society, and we're going to get through this. And on the right-hand side, which is all of a sudden very much hitting home, in particular this month, we have the direct results of climate change. The substantial parts of Europe have had an incredible amount of rain, which has placed countries like Belgium and Germany, Austria, Switzerland, whole villages are underwater. And that, of course, it's not difficult to figure out that this will have an impact on economic growth, on corporate profits, and the likes. Personally, I think, and this is also further coming into that whiplash market that I described earlier, I think barriers like this, events like this, they will have an impact on equities and on other financial markets like currencies and especially the bond market. But I think it has to become a lot worse before it will destroy this market, I think, which is not inconceivable, not saying that can't happen, but that is, at this point in time, is not yet the case. It has to be watched, though, because there's always the feeling that when markets are highly priced, and there's no denying that this market still is relatively highly priced.
I left it there for a blind tasting.
That and some people should definitely use their mute button. There's always the chance, of course, that this can get worse and that this can pull down the market. But at the moment, this market is very much carried by a very strong upward momentum in corporate profits, in dividends, and in forecasts for profits and dividends. Now, to give you a little bit of an insight, luckily, I did found FNArena almost 2 decades ago. And one of the things that we can do at FNArena is because we pay attention to corporate profits, is we can dig into the data we have. And one of the things we do is now we keep a close tab on corporate profits in Australia. We've been doing this since 2013. And over that period, I can confirm that looking at the data that we accumulate from the recent reporting seasons, that corporate profits in Australia have never been as strong as they have been for the past 6 months. And what I mean by that is that I'm reasoning from the way that the financial market operates. And the financial market operates in the sense that the market lives by forecasts, and then profits from companies come out and they turn out to be a lot stronger than even those forecasts. And even those forecasts were rising, the corporate profits were still stronger, so they need to rise further, which then usually has the effect that share prices have to rise further as well. And where I want to point your attention here to is that on the bottom side of this on this chart, we have the reporting season in February, and that had a beat ratio of about 47%. That was the second highest that we recorded. The highest was the season before that, which had 49%. And then we have the results from profits between February and now. We're almost getting to the August reporting season, and the beat ratio there was 55%, which those numbers are usually quite common in the United States. In Australia, I can guarantee you those numbers are not common. And this is the irony what a big crisis like the one we experienced in 2020 has done. It has completely changed the dynamic for the share market, and it has given a lot of companies the opportunity to slim down their operations but also to start anew and to get new momentum behind their profits, and that has translated in very strong recoveries in share prices. Now, another way of looking at the share market, and this one is very surprising, I can tell you up front. One of the things we do at FNArena is we register the buy, hold, and sell ratings of the stockbrokers in Australia. And what usually is the case, and that this is very, very logical if you think about it, what usually is the case that in down markets, in bear markets, the number of buy ratings really rises to a very high number, well above 50% in the share market. That is logical because stockbrokers keep on telling investors that there's more value to be had in those stocks, but investors have no appetite for it because the sentiment is very downbeaten. And that only gets resolved over time with the share market going into a new bull market. And you can clearly see on this, what you should watch for is when the blue line goes over the orangey line, because the blue line are the buy ratings and the orangey line are the neutral and the hold ratings. You can see when we came out of the 2004, 5, 6, and 7 bull market, that we had more than 50% of the ratings were in the neutral and the hold category, and we had at times in the 30s percentages of buy ratings, and that is a normal bull market. Share prices get too expensive, brokers put a neutral rating on it. And you can clearly see here, if you go back in time, here's the GFC, here's the Euro crisis. This is late 2018, we have 2012 is here. And all of a sudden we are in 2021, and the number of buy ratings is rising deep above the 50%, which is very unusual. Usually, looking at this chart, I would say the share market is very depressed. In this case, the share market is a new all-time high, and we have almost a new all-time high in percentages of buy ratings. At face value, it does not make sense, but it links in with my other observation this year, is that shares are actually being governed now by cautiousness and by skepticism from investors. Investors are very reluctant to put share prices at full value because they're a little bit afraid of what the next 12 months might deliver after we had such a strong 12 months. But again, you can also interpret this as a different scenario of the very scary backward-looking PE ratio I showed you earlier, this would negate that type of analysis. Now, further on, moving from this one, the other thing that we do as well is we keep track of where share prices are in comparison to where stockbrokers think they should be. And what we do is we calculate consensus price targets. And I'll just show you on this one to show you the difference, is that this grayish zone here on each chart is the consensus price target. And I've taken two banks because we're all aware with Commonwealth Bank and with Westpac. Now you can clearly see that Commonwealth Bank here is trading well above the consensus price target, and that's because Commonwealth is used to trading at a premium, and Westpac unfortunately still has some space to go. So Westpac is below target. Now what we usually get in a very strong bull market is that the percentage of stocks that are trading above target is usually gets to a very high percentage, and that basically means that we should be careful. Share market gets a little bit hot under the collar unless those targets obviously have to rise. Again, what makes this current bull market very unusual is that I've put some statistics here together, but in a very brief format, only 25% of the stocks is trading above target at this point in time. And these numbers are from a few days ago. That means that 3 out of 4 stocks in the share market that we pay attention to are still trading below target. Again, feeding in this idea that at face value it would appear that the market is at the very least fully valued. These numbers don't suggest that is the case. It seems to be that investors still leave enough on the table as a sort of a cushion, of safety, that they don't get caught out in terms in case that maybe the second half or the first half next year don't live up to expectations. And I even this statistics here for the top 20, and you can see that out of the top 20, only 4 stocks are trading above target, and I could justify all 4 of them if I wanted to. Again, further reinforcing that view that this is quite an unusual type of bull market, where things that look very, very expensive on the outside are looking very less so from the inside, and the context is very important when you invest, and it has proven again this year so far as well. Now, there are 2 other things that obviously will prove to be very important, and they are both reasons as to why investors in equities this year have become a little bit more cautious, I would say. One is, of course, central bank policies, and we are all watching what the Fed is going to do with their extreme stimulus program. There's no other way of calling it. And so far that has worked. It has kept support on the share markets, and it is facilitating a recovery in economies. And there's the other elephant in the room. That's the bond market, and the bond market is playing an increasingly important role about what is happening in share markets this year. We all know this chart. I'm assuming this chart shows us what has happened to U.S. government bond yields since the 1980s, and there were times when that was 16% you could get on a 10-year Treasury in the U.S. Nowadays, you're lucky if you get 1 point something percent, and there are a lot of theories around this. There are a lot of scary prospects. There are a lot of people who are uncomfortable with this. What we've seen is a trend of 40 years, and we don't know yet whether or when that trend is definitely going to be broken. What we see is, and this actually gives a little of context, at the very right you see that there's a little bend to the upside there. And that is where we all got scared of, and why we got a lot of volatility in the share market, and forecasts that at the end is near. If we look a little bit more in detail, what we see here is that in the past we had these bond yields rising to 3%, and that turned out to be the maximum they have been able to rise over the past decade or so. Then we had 2020 coming, and we went to 0.52, which was very, very low. As we priced out the emergency, and we were supposedly on our way to 2%, that sort of stopped in mid-March, and we're basically now almost back to 1%. We went to 1.13 last night, and that has confused quite a lot of people. There are a lot of theories around why bonds refuse to play the script. I'm by no means going to exclaim that I know all the answers here, but I have put together a few reasons here as to what exactly is happening in large bond markets around the world right now. The one I highlighted is point number 6, and I do believe that at this particular point in time, that is the major reason as to why bond markets are going, well, they're rallying, so the yield is going lower instead of selling off and the yield going higher. I think too many people are blaming the Federal Reserve for this. I think at this point in time, it is merely the failure globally of governments to accurately handle the virus, basically. And I mean, sadly but true, but we have to include Australia in that now as well, with Sydney and Melbourne and New South Wales and Victoria, I should say, now in lockdown, and some of the other states on the verge or already moving into short-term lockdowns. It is well possible that on a technical measurement that Australia might have a recession in 2021, and I don't think too many people would have expected that to happen. We can talk about this until the cows come home. The forecasts with regards to the bond market are really wide open. There are still a lot of people who think that bonds will be at 1.8, if not 2% by year end, which means they will have to do a lot in terms of making up for all this in the second half. We'll have to see. One of the question marks in the background is about inflation. I can virtually guarantee you that 3/4 of market participants around the world are of the same view as central bankers, in that the inflation that we are seeing coming through in this year's numbers are transitory and they won't be sticking around. But of course, the big risk for markets is that if that somehow the expectation is incorrect, we will see some big moves in markets, and they won't necessarily be to the positive for equity investors. Now, having said so, I touched upon this point earlier, and it has been and still is one of the big support pillars on the share markets is this extreme stimulus, extreme support provided by central bankers, and market is now looking forward to that has to, as the economic recovery is playing out, it's now being delayed again because we have the pandemic, we have climate change hitting home, so it has been delayed again. But previously, if we go back a few months, we were very, very optimistic about this, and that means that central bankers will somehow have to wind back their stimulus programs, less QE, if not no QE, and they have to start raising interest rates. Now, the good news is, if you can call it like that, is that our neighbor across the Tasman is going to be the first central bank, the first country that will show us how it's done, and it's New Zealand. As you can see on this top chart here, the red line is basically the interest rate in New Zealand and the forecasts how that is going to develop. And they will, according to this forecast, they will later this year already start raising interest rates. And what is noticeable here is that on Westpac's forecast, this is Westpac's forecast, by the way, but I don't think they're too far off from the rest of the market, is that ultimately when they stop raising interest rates, they will stop at a higher level as where interest rates were before the pandemic. And that is quite remarkable, because there's quite a few people around, and I would be amongst them, who think that we are not going to go back anytime soon to where we were in the past. And The explanation for this is that New Zealand is quite in a different environment than we are in most economies. It's a small economy. They don't have much of a pandemic going on. Their inflation is looking much stronger. Their labor market is looking a lot stronger. And their economy, as you can see on the left bottom here, has already recovered in full to where it was pre-pandemic and is from here onwards forecast to grow very, very strongly and pick up that trend that was briefly interrupted in 2020. That is quite a different situation than from the rest of the world. If we go to the US, for example, here are the forecasts of what will happen. And it's probably going to take another maybe 2 years before the Federal Reserve will actually raise interest rates. They will start tapering quicker, and that might happen early next year, or maybe late this year they might announce it. But when they actually start raising interest rates, the cash rates, that is probably still 18 months to 2 years, if not longer away, depending what happens in the meantime. And according to forecasts, and this is pretty much a general forecast where the most forecasters would stand, is that when they finally stop hiking interest rates again, it will be not even near to where interest rates peaked the previous time pre-pandemic. And now we have that chart in front of us. Here's something I want to show you. This peak is lower than this one, is lower than this one, is lower than this one, is lower than this one. So in line with those bond yields that I showed you over 40 years, you can draw a similar trend line when it comes to the cash rate in the United States. The problem the solution, of course, is that it's a big mountain of debt that keeps interest rates at very low levels. Central bankers are very much aware of this. The only thing that might be able to upset this picture is if we get a breakout of inflation. At this point in time, I would say that even the more bullish people are not expecting that to happen, or definitely not to last. Another element I wanted to draw your attention to is that while we're all focused on what happens at face value to bond yields, if you correct bond yields for inflation, which is essentially how you should look at bond yields, they are still very, very much in the negative in the United States, up to 1% in negative. They will not rise a lot into the positive, I would assume, over the next decade, because I believe that central bankers won't allow it to happen. That is the new world in which we live in. Now, when it comes to Australia, I've already put in the title. Our scenario is very much like the US and not like New Zealand. So what will happen is that at some point, probably the RBA is going to wait until the Federal Reserve starts raising interest rates and then follow suit. And similar to the United States, when the RBA is finally done with raising interest rates, it will be done at a lower level than where the previous peak was pre-pandemic, and that was below the peak before that, and that was before the peak below that, and that was before the peak below that, and you get the same trend line. This. Long story short, whenever you read commentators in the newspapers or you see some people saying, well, what happens if interest rates go back to where they were in the 90s or whatever, you just dismiss that, because I can almost virtually guarantee you it's not going to happen. You know what I mean? The chance of that happening is probably, I mean, you're easier to win the lotto, right? It's very simple. And you can see here, for example, on the right-hand side, that the economic growth in Australia still hasn't fully recovered from where it was pre-pandemic. And now, of course, we get another slowdown activity because we're on lockdowns again. So it's going to take a lot longer than, for example, in the case of New Zealand. Now we have the big macro stuff. There's something else I wanted to highlight here, and because we're all very much concentrated on what happens to the banks and our dividends and the resources stocks and how long can iron ore stay above $200 a ton US. The big shift this year in 2021 is actually happening in the property market, in real estate. And I'm actually a little bit surprised that not more people are catching up on this. But I thought this is the ideal audience to highlight this, because what exactly is happening is that previously I would constantly tell people that the share market is very much bifurcating. It's polarizing. And the share market is putting a higher valuation on certain sectors, on certain companies, and a lower valuation on others. That element now is increasingly becoming visible in the real estate market. And this is why I thought this particular chart from the National Australia Bank is quite remarkable, because it divvies up the different categories that we have on the share market in terms of property owners. And we have those who own office, those who have obviously the retail, predominantly shopping malls, regional or in CBDs. We have the industrial owners, and we have the hotel owners, leisure and hotels. As you easily can see from this chart, it's all to the negative in terms of valuations of those assets, with the exception of the industrial side. The orange bars you see on this chart is for the next 2 years on the expectation of National Australia Bank, and you see again there's an increase here for industrial. There's a little bit of recovery happening here in office, but all the rest you see it's still pretty much it's not happening actually. It's negative here, and it's very much negative here. To a certain extent, that is the impact of the pandemic. I mean, we all know hotels are by no means fully filled up at this point in time, and there's probably not going to happen anytime soon. But there's obviously there's more happening than simply the pandemic. It is simply as I was listening to an explanation this morning by one of the big Wall Street firms, and they basically said, well, you know what, the market, the big investors around the world are seeking out quality from the rest, and it's being reflected in prices for assets. To illustrate a little bit what happened over the past 6 months, I've selected here some of the names we all have on the stock exchange, and we all know them because they're all property owners in a certain sense, but they are different types of property owners. And what you see in some cases, for example, in Goodman Group, is that they sold off first because we had that very strong rise in bond yields. But then they recovered very, very quickly. If you combine this with that, you almost have 30% of the recovery that you could have made if you would have bought them after the sell-off. Goodman Group has been one of my favorite investments over the past few years. Another one which I actually picked up after the sell-off is Charter Hall. So Charter Hall is unchanged for this year, but it compensated for a 22% sell-off on the bond yields first. There is an enormously strong performer in Centuria Industrial REIT. And what these companies have in common is that they've all benefited from the strong revaluation of industrial assets. And while they are probably the prime beneficiaries this year, in that we are all when I say we, I'm talking large international investors who put money in infrastructure and in real estate. We all are now developing a preference for quality assets in the industrial space, and we have to think about warehousing, but we also have car spots, we have childcare centers, we have storage, and not just any of them. We are trying to seek out the high quality ones, and we're bidding them up, and the prices are going high. We have a very strong bifurcation in that market happening, that if you are an owner of a regional shopping center mall right now, nobody loves you, essentially. If you are the developer of high-end warehousing facilities, for example, Goodman Group, everybody loves you. And the big question mark, of course, is this a fad, a temporary event, or is this the new outlook for real estate assets? It's a question mark that will only be answered in the years to come, of course. But the trend at this point in time is very much towards seeking out the quality assets and placing a higher valuation on that. And I haven't seen anyone yet who has predicted this will come to an end anytime soon. The best performing are the ones who are behind a home consortium. If you're not familiar with those guys, very entrepreneurial. They're very much caught up on the new signs of the times. And this is actually a business model that has developed out of the failure of Woolworths and Lowe's from the US to create a competitor to Bunnings in Australia. I'm still on the REITs here. I'm still on the real estate. I'm not going to stay there forever and ever, but just a different way of showing you how things have developed over the past decade, and in particular in the past 2-3 years. This chart shows you the various parts of real estate on the Australian share market as they made up a percentage of the sector index. So it's a relative comparison here. And you can see that 10 years ago, almost half of the local index was compiled of retail REITs, the likes of Westfield and vicinity centers, etc. Big shopping mall owners, and they made up half of the index, and large investors were more than happy to add those to their portfolio, steady dividends and etc. Now, over the past years, it has dramatically changed in that sector, that part of the sector represents now less than 20% of the total index. And where does the difference come from? Here, industrials. Those are the Goodman Groups, the Centurias, and the Charter Halls. You have some diversifieds who have benefited a little bit, and that's predominantly because they also have the industrial side. And you have the so-called alternative REITs. And with the alternative REITs, I'll go back to the previous one. You have to think about the home consortiums, the Aventus Groups, the Arena REITs, the Rural Funds Group, and a few other ones. And you can probably also include the Charter Hall Social Infrastructure, which essentially is also a childcare center and some government departments. And that is basically the revolution, if you can call it like that, that is still happening in the real estate market. And of course, it has already had tremendous impact on share prices in the share market. Now, that's not the only thing that has happened, of course. We have a lot of changes that have happened through COVID. And this one I wanted to highlight, because this one is going to be important past this year. So what has happened last year, and by the way, if you look at the yellow line here, that is the forecast of how much of the percentage of total spending in Australia, total consumer spending, would go to online, to the internet, instead of in bricks and mortar. And that's the yellow line. And according to those forecasts made by Frost & Sullivan, which is a consultant to the industry, that by 2024 we would have a little bit more than 19% of retail spending would have shifted to online. What has happened through COVID is now we have that orange one. So it has completely pulled forward in acceleration that trend. And in that same time frame in 2024, it would now projected to be almost 25%. Now let's round it off. That's a difference of six percentage points. It may not seem like a lot, but it's massive, because we are talking the total consumers, total retail spending in Australia. So a 6 percentage point difference over that time frame is massive. And that is, of course, why last year all those online retailers, they remember the flavor of the month, the flavor of the year. This year, many of those retailers will have a tough time, because the pull forward happened so quickly last year that they might have temporarily a problem this year in beating those numbers or in creating a lot of extra growth on top of those numbers. But if you look at these forecasts, then I think the conclusion has to be that trend is not going to change. So I would, on the basis of this, I would say like they can have temporary lull in their uptrend, but by no means is this mega trend going to change anytime soon. And I think this is about as appropriate as any other time to highlight that what COVID has done, what the pandemic has done, on top of the technological revolution that we were experiencing pre-pandemic, is that it has created this divergence in the economy as well. We clearly have winners and losers, and you can lose two ways. I mean, if it's not because of technology, you can lose because of the pandemic. And while I'm sure you remember last year, all the rage was about what type of economic recovery are we going to get? Is it this shape? Is it that shape? Is it W or U or is it V? It turns out we have a K, and the K picks winners and losers. And I think this is very important because the share markets and financial markets often they live in the here and now, and that is often what is reflected in share prices. But for an investor, you want to look, I think, beyond the immediate, and then it's probably better to pick the winners than the losers. And the valuations, of course, are reflective of that. Now, I've put together here a few mega trends, which I believe they're called mega trends for very, very, very good reason, and it is that they will be with us for a very long time. And instead of trying to emphasize now that we're all going to big data and cloud computing, and we will have digitization, including money, cash, of course. One of the mega trends that might surprise you is the ESG, environmental, social, and governance. It has been declared a mega trend by quite a few people, and I mean, I can't almost not see a research report these days that is including it. In Australia, those matters have been very much politicized, but I can guarantee you, if I look at the international landscape, there is no escaping. It is happening, and you can argue that in many cases in today's share market, you can see companies with a bad rating on the ESG filters not performing. Of course, we will also have the high debt and low growth environment, which I believe is going to reinstate itself at some point. I mean, the strong recovery we're seeing this year is only because we fell so deeply last year. And at the very bottom, of course, I think this will increasingly start playing a role as well. I mean, the politicians might have a discussion about this. Financial markets will increasingly have less of a discussion about climate change. That's pretty much a given. If you combine all what I've just told you, then, and in particular over the past month or so, is that we've had a share market that has a lot of dynamics happening, but it's very much carried by strong earnings recovery, but also with a lot of question marks of how long that's going to last and what's the outlook for the next 12 to 24 months. We don't know exactly how the Federal Reserve and other central bankers are going to wind back their extreme policies. There are a lot of question marks now because of climate change actually happening in Europe, or the results of it, and of course of the pandemic, which a lot of governments don't seem to get under control in a sense that our more optimistic scenarios would have liked it to be. And so there's a trend back in the share market now, and it has been confirmed by recent surveys and also by some of the research I get across my desk here. There's a trend back to adding quality to portfolios instead of low quality. And we can all have our own definitions about what makes a quality company, but if you're familiar with my type of research, I mean, I spend a lot of time in weeding out the quality companies from the less quality ones. And instead of going towards return on equity and management teams and all of that, I think the best definition of a quality company is that over time, which is here the yellow line, over time, the value that comes out of the company increases. I mean, and this is what happens in the modeling when you cross that, and this is what happens in the share market. That's the red line, of course. And the standard joke is that if you pay too much for a quality growth stock, you have to wait 6 months before you get your money back. If you do it with a not so quality company, you may have to wait 6 years. And that, I think, is sort of like summarizes the difference. I'm very much a big fan of buying quality myself. And there are times when quality doesn't perform. It's because of all the rest is performing. We've had that between October last year and March this year. It may well be that, stimulated by the bond market in the second half, that we will again have a period when momentum flips and switches. But I think through the cycle and throughout the years, quality keeps on performing, keeps on proving why it is quality. And I always think there's not enough attention in the share market for corporate quality and too much emphasis on the share price. We have a lot of questions, and it's very much, at times, it's very much the bond market that decides who's going up and who's going down in the share market. I've put together a list here of bond market direct influences on the share market. It's not something that I've done myself. This comes from Wall Street Research. It's from historical data. The sectors on the top are either the biggest winners or the biggest losers, depending on which table they are in, and then it goes down. So, for example, food and staples retailing on the right-hand side is one of the lesser losers from higher bond yields, but technology hardware at the top, they lose a lot. The problem, and the reason why I point this out, is that at some point it will become important again, but it also becomes very much a short-term versus long-term perspective, because people will reason that those stocks on the top-hand side or left-hand side are the ones that give you protection against inflation, but they also are very much in sync with bond yields and with the economic cycle. And I actually think that a lot of companies on the right-hand side that are losers of bond yields are actually giving you protection against inflation, just not in the immediate term. After the correction, that's when you buy them, or that's when you're happy to pile up on them, because they will give you ultimately the better protection against inflation, instead of the usual suspects that are always being called upon. The special mentioning here at the bottom is when everyone always buys gold for inflation protection. I think that's a furphy. If you look into it, gold always gives you protection when people run scared. The whole inflation saga is the immediate knee-jerk response. You come back 6 months later, it hasn't happened, and that's typically the role of gold. The irony is that if you analyze historical patterns for gold actually performs much better when there's disinflation or even deflation, instead of when there's inflation. And one of the reasons for that is that gold is amongst the losers of higher bond yields, as you can see here. That's one of the correlations that too few people in this world understand. Now, in case you think this is getting quite long in the tooth, I can tell you now we are really approaching the end of it. One last point I wanted to make is that the past decade or so has seen an extreme polarization in the share market. I've just explained to you that in 2021, past 6 months have seen what appears to be quite an extreme polarization as well in the asset market of real estate. I can guarantee you virtually that the same is going to happen in the commodities space. It may not necessarily have become apparent right now, but it will increasingly become apparent over the next decade that we will have winners and losers in the commodity space. And the super cycle, if there is one in the decades ahead, that has been predicted by quite a few people who specialize in this space, I can guarantee that will not be a copy of the super cycle we had that was previously driven by the China awakening, let's call it between 2003 and 2008. It will be very much different, and it will actually be driven by some of those mega trends that I've I've mentioned earlier. It will be about green energy and by electrical vehicles, etc. And I mean, a few simple things to mention is that we are going to wave goodbye to coal, and we are going to wave goodbye to crude oil and gas. It just won't happen overnight. And the irony is that while that process is happening, that all those sectors, because they're commodities, they will go through a period where those existing producers will actually be enjoying quite high prices for as long as it lasts. And that's the irony of investing, of course. It's short term versus long term. I hope you all liked it. Just a few closing remarks from my perspective is that in line with my research, I do run a portfolio, and I've sort of touched upon it earlier. I do concentrate my research on finding quality in the share market, and I'm very much less inclined to go with whatever is popular at that particular point in time. I've learned over the years that the most important characteristic of a quality company is a company that invests in the future. And the longer I do this, I keep on coming back to companies who invest in the future. And I'll give you a practical example of that, is that I own both Woolworths and Coles. But I always was of the view that Woolworths is the better company, is the better franchise. And I've again, over the past year or so, I've come to the conclusion, because the Woolworths share price has performed much better than the Coles share price. And I've again come to the conclusion that the difference between the two is because the final years of Coles under Wesfarmers ownership had stopped investing in the business. And now they have to sort of play catch up. That means they have to invest more, which then weighs on their prospects and on their share price, of course. While Woolworths is just the one who continues to invest the most. And therefore you get rewarded as a shareholder in a much better way than in shareholdership of Coles. And I can give you plenty of examples where that's the case. It comes back to investing in the business. And that also means that you have to look beyond the immediate profits and dividends that come on your plate. Having said so, we're looking forward to August. I think what you will find in August is that we will have record, and literally record, payments coming towards in dividends to shareholders. We will have an enormously fast recovery in corporate profits, and we will have a lot of special dividends. We will have buybacks. We have a lot of corporate action that will be happening. So there's a lot of action happening that typically goes with a very strong bull market, and I think too many people are too focused on the end of the bull market. Having said so, I think the headwinds are there. I don't think at this point that they will derail whatever is happening in the share market, but you never know, because at the same time, it's always a correct time to become a little bit more cautious when you've had such a strong advance in equities over the past 12 months. Just in terms of people who might be willing to read a few of my stories, which might give you a different perspective on things. I did this a few years ago, and I regularly update this report. But we have this secret report that you can download for free. It's behind this. You do slash secret after the address of the website, and you'll see there's a report there. And then I also know people get rewarded who pay attention to my presentations.